Hello there, and welcome to another live webinar with us from Phillip Nova. And what are we talking about today? We're going to be discussing a topic that is very interesting for many stocks traders. And if you're keen to learn more about futures, options, and daily leverage certificates, this is the webinar for you. In the studio, we have none other than professional trader Tom Yuen. I'll tell you more about his experience in a short while. And we will be discussing understanding futures, options, and daily leverage certificates today. Tom Yuen, as I shared earlier, is a professional trader, and he will share the differences between these financial instruments, futures, options, and DLCs, and how you can trade them. Tom will also share how these products will complement your stocks trading. And a little bit about Tom right now. Tom is a futures trader with extensive system-based trading and execution experience and a strong background in quantitative technical analysis. Tom's futures trading experience spans over 30 years, with the first 14 years spent as a floor trader with Singapore International Monetary Exchange, known as SIMEX, and it is now known as SGX Derivatives Trading. With no formal training in the financial discipline, he developed his edge through his strength from the technical field, coupled with an immense interest in psychology. He traded trading methodologies that derived purely from technical analysis. With a delicate blend of math psychology, Tom is able to be in a position that he's able to teach us how to trade effectively. And Tom, if you're all set to go, you know what? Before I hand the reins over to Tom, can I just do a quick sound check with the members of the audience? If you can hear us loud and clear, please type a resounding yes into the question box.
All right, mic test, mic test.
Yes, I hear you, Tom. Loud and clear.
Okay, very good, very good. So I'll take over.
Just 1 second. Members of the audience, at any point in time, if you have, thank you, Han Fong, for confirming they can hear us. Members of the audience, at any point in time, if you have questions, you can type them into the question box, which is located somewhere at the bottom of the control panel. There's a question tab. Click on that, and you'll be able to send us questions, which we will address in the Q&A at the end of the webinar. Thank you, Patrick, for confirming they can hear us. And Tom, if you're all set to go, the floor is yours.
All right, thank you very much, Philip, for co-organizing this. My name is Tom. I'm not sure if any one of you have actually attended my webinars or seminars before. Today is going to be a rather jam-packed 1 hour session to talk about these few things. So without further delay, I would start. All right, understanding futures, options, and daily leverage certificates. In short, we call it DLC. Just to do a quick intro on me, I come from the floor, right? Just now, MC already talked about floor. This once upon a time called SIMEX or open outcry. This is where I used to work, trading my own account. So people usually ask me, so where are you? If you zoom it in, that is where I am, and this is how I look like in 1994. The proof of this being so long is that fella standing next to me is still there. Okay, those of you who are senior enough or knowledgeable enough, you will ought to know that this is the fella by the name of Nick Leeson, who single-handedly brought down bearings in 1995. Yeah, so I always show this slide to introduce myself for two main points. Number one is to prove the timeline as to how long I have been a trader. Since 1992, I started joining the floor. 1993, he came in. 1994, we made this video clip, and 1995, he became famous. Okay, so that is the proof of the timeline. And number two is also to share with you guys the importance of understanding what you do. Because if you do not understand, it doesn't matter whether you're individual or institution, you can also end up in a very disastrous manner. Yeah, so therefore with that, my next natural slide will be the disclaimer. This is a disclaimer by from SGX, whereby I am a residential trainer for more than 10 years. So instead of reading to you the details, right, I would prefer to substitute the way I talk about disclaimer with 4 simple words. Number one is high risk, yeah, and number two is high return. So basically, are you experiencing high risk or high return? It depends on what. It doesn't depend on the trainer. It doesn't depend on the instrument. It depends entirely on you. All right. If you have a knowledge of the instrument and you know what you're doing, you're skillful enough, you shall see returns. But if you've got no idea and you still want to blindly go and touch it, you will likely see high risk. Okay, so therefore, that would be the way I summarize what the disclaimer means. Yeah. Now, before I continue, why do I decide to do such a topic on differentiating between the couple of that few trading instruments? Is because over the last more than 10 years of doing education, I always come across these two very commonly asked questions. Tom, what is the difference between Forex and futures? It is such a wrong question until I also don't know how to answer. At the end of this 1 hour, you would be able to answer this question yourself. What is the difference between Forex and futures? All right. And then another very common question is people will simply candidly ask me, is futures the same as options? They both have expiry. All right. I would always candidly tell them, you go to the NTUC fair price, you look at the eggs, also got expiry. It doesn't mean that everything got expiry means they all lumped together. Now, again, at the end of this 1 hour, you would understand why futures got expiry and why options got expiry, and yet they are different. Okay, so let's start. And again, I want to highlight that each of these topic itself, elaborate coverage will take minimum of 1 hour to 3 hours. So therefore, with 1 hour, I'm talking about these three plus more. There can only be a conceptual understanding. At the end of this, whether you're able to straight away utilize them depends on how well you can take home the concept and translate it into theory and practice. All right. So therefore, keyword conceptual understanding, this is my aim to let you guys know for tonight's session. All right, so I will be talking about mostly futures, options, and DLC to compare them, and related to them, also at the end of this, you will also naturally understand ETF and CFD. So I'm going to compare these few together. So before I go on, all right, now I want you to understand this model, that if you wish to make music and you enjoy making music, there are two important components. Number one, you need to understand music theory, or you need to have a good sense of how music works. That is the theory part. Yeah. Then you need to have good musical instruments, without which you cannot produce music. So to summarize again, to enjoy music, to make music, you need the left and the right put together to produce music. So similarly, if you wish to make money from the market, just like making music, you also need the left and the right. You need to understand the theory of how the market behaves, yeah, including the word I call behavioral finance. That means not only the fundamentals, not only the supply and demand, but the human psychology involved, right? Fueling the market. So actually, the market movement is not entirely random. There are certain order. So if you understand the theory of it, you will be able to establish a potential swing low point, swing high point, and you're able to establish trends. So those are the theory part. And then same thing, you need to have good instrument. So therefore, combining a good understanding of theory and using the appropriate instrument, you will be able to produce money. All right. So today's session is on this. So I'm not going to teach you how to trade. I'm not going to teach you about market theory. But today's 1 hour session is on the trading instruments. All right. Okay. So before we go on to talking about these trading instruments itself, let's recap that most people would understand stock trading, stock and shares. Yeah. Now, this is a DBS chart that I have prepared over the weekend that spanned from last year, November, December, whereby it formed a swing low before going up to reach a high of about $37.49. And then over the past few months, it has gone all the way down to here. All right. So assuming that you have decent theory and you understand the market, yeah, to establish that during December last year, that the market come down to here around $30 would be a good place for you to buy. All right, assuming you have that theory. Now, to buy $30 DBS and hold it over about 1 month plus into the year, it went to $36. Yeah, I don't want to talk about this higher. So from $30 going up to $36, that would be a 20% rise. It's very simple maths. $30 you buy, all right, going up $6, that will be about 20%. So remember this percentage return. Okay, at the same time, I used to remember long time ago, one lot of shares equals to 1,000 shares. So to buy one lot, $30 times 1,000, that would be $30,000. Of course, later on, they reduce the lot size to 100, all right? So assuming that I still stick on to one lot equals to 1,000, you would have to put up $30,000 to buy one lot of DBS, hold it up to $36,000, yeah, and you make $6,000 return with 30,000. So this is something that most people are familiar. Dealing with stock and shares. Even if you don't trade stock and shares, it is also easy to relate to this. All right, and that is called outright trading, and that will be investment. Investment meaning that you are always looking to buy low and sell high, yeah, and you do not really like the market to come down. You always want the market to go up. That is investors mentality. Okay, so with this backdrop, I'm going to compare what I want to share with you guys tonight with something like DBS, yeah, for example. So let's start with talking about futures. What if DBS has got a futures derivatives to trade the DBS itself? But before I talk about that, I want you to understand the concept of futures. So over the next 10 minutes, I'm going to give you a conceptual illustration of what futures is. Yeah. So now you clear your mind and you listen to the story. Follow to my illustration of a story. All right, assuming that you want to go to an electrical store and buy a fridge. So typically what happens is this: it is not possible for you to pay the money and then take the fridge and you carry it home, correct? So typically the procedure is you have to pay a deposit, yeah, a deposit to say that, oh, I am interested to buy this, and then you fill in the form, the whatever it is, and then you have to arrange for a future date to deliver. So the electrical store, they have the time to deliver and you have the time to take the delivery at home, and that is the point at a future date whereby once it's delivered to you, you pay the balance, and at that point in time, the transaction is over. Now, this concept is called a forward contract. In the financial market, from the point whereby you decide to start a deal, yeah, that you cannot complete on the spot, and you need to delay until a future date before it is completed. So this is called a forward contract. Something that is not difficult to understand. So right now, I want you to remember two key terms, yeah. That is the deposit, which is typically a fraction of the whole price, yeah. Assuming that you buy a fridge that is maybe $3,000, you perhaps pay $300, all right, down payment, and then you buy something that is $3,000, yeah. So the deposit and then a later delivery date. So take note of these two terms. All right. If you're okay with this, I'm going to show you another example to illustrate further, yeah, of what forward contract is. This is another example of a forward contract. If you wish to purchase a property, very often the developer, after acquiring the land and they start constructing, they will not wait till it is over, then they will sell. They will start selling, all right, while this is being constructed simultaneously. So typically, they will build a mock-up apartment, yeah, which we call show flat, and to show you that, oh, after it's finished already, if you renovate it, it can look like this. So typically, at this juncture, when we go to the showroom and we look at it and we are quite keen and we decide to buy, yeah, we decide to buy, yeah. So you will put a down payment. So similarly, this is another example of a forward contract because you cannot complete the deal on the spot because this is not ready yet. So it has to be completed at a future date, all right? So because of this, it is also under the category of a forward contract, just like the fridge. Now, so similarly, you put a down payment. For example, a $1 million project, I'm just simplifying the procedure, assuming it's a $1 million, and then you pay $50,000, right, as a down payment. And then again, to simplify the procedure, I don't want to talk about progressive payment or whatever. So assuming that you pay 50,000 and you wait all the way until TOP, whereby you have a temporary occupation permit, that is when the developer would hand you the keys and hand over the unit over to you. And that is the time where you would pay the balance, all right? If you're cash rich, you pay everything and the deal is over. But otherwise, you would take a bank loan and then you would pay the bank installment, but nevertheless, between you and the seller, at this point in time, the deal is over. So this is another example of a forward contract. Okay, now this example, I want to illustrate something else to you. For example, last time, yeah, I remember the first time I come across this term called flipping is in 1994-95. If any one of you who are informed enough to go all the way back to history, 1993 was a bull market, was a very strong bull market in the stock market. Yeah, after running 1 year to a very a bullish height, it started to drag everything else up, and the property market started to also rise in 94, 95. that is when some people start to know the lucrative of doing flipping. Basically, what is that? All right, assuming that you bought the unit at $1 million by paying $50,000, now waiting for TOP delivery, right? While you're waiting, this whole block is being sold, all right? So people continue to trade in the black market, and someone got hold of your information and realized that you bought a unit. So one day you receive a phone call. Hello, Mr. Tan, I know that you own a unit here. Now the current market, in the black market, it is already traded up to 1.5 million. $1.5 million. And are you willing to let go? If you're willing, I'm willing to pay you 1.7 million. All right. So you do your calculation. Wow, you bought for 1 million, and now before receiving the good, you are able to sell it away from 1.7 million. You make $700,000. Yeah, net, gross, before net. So therefore, this thing is the market, right? So someone offer you 1.7. So take note, how much do you make? You make, someone offer you 1.7, so you make $700,000. And how much did you pay? You put down only 50,000, and before receiving the goods, you can sell it away and earn $700,000. All right, so this is what they call flipping. Now, a lot of people, I share with you a true story. In 1994-95, there is really a newbie called Mr. Tan experienced this. After that, what happened? After that, the next available unit, he go to the new show flat, and he used his profit of $700,000. He bought 10 units. All right, putting a down payment of $50,000 each. He bought 10 units, spending $500,000, and go home, and he started to wait, expect 10 phone calls, so that now he can sell away this new 10 units with $700,000 profit each. Yeah, so that is his dream. But unfortunately, after the first good experience, the subsequent experience was $1 million. The market actually tumble and crash. All right, it crashed. It can go as low as losing 50%. So now in this case, instead of making, he is actually making a loss of $500,000 for one unit times 10. So what is the outcome in Hokkien? Pork guy. All right, now, so right now, what have I shown you? Keyword down payment, which is something like a deposit. All right, and then you have a TOP before the transaction is over. Then you have the concept of flipping. Flipping means that you do not wait for this whole contract to be completed, and you are able to sell it away to make a profit. Yeah, so that is the gist. Now, if you can understand this, all this concept, basically that is what futures is all about. The conceptual understanding of futures is you go to the exchange. All right, so futures, in another words, is actually a forward contract that is regulated. So you go to the exchange and you see what is available in the exchange. They would list whatever product that can be traded in the exchange, right? For example, if you have a fridge that can be traded, you can go to the fridge and go to the exchange to buy a fridge. If the property are listed in the exchange, you can go to the exchange to buy a property. All right. Now, otherwise, you have things like buying index, buying gold, buying interest rate, buying oil and whatever. So therefore, you go to the exchange, you see what are the products that they have, and as a buyer, you need to only pay a margin. So this margin concept, I'm sure many of you would have heard of it. Yeah, what is it? It is actually a good faith deposit. It's just like a deposit, which is a fraction of the worth product. In the example of a condo, 1 million, but you pay only 50,000, right? So that is equivalent to a margin. And you actually want to wait until expiry to deliver, to receive the good. Yeah. So therefore, futures, the whole original idea is for genuine buyer and seller to meet together and put up a transaction so that they can do the delivery when it expires. So the expire is equivalent to the delivery date that is being set, right, to receive or deliver the goods. Now, so now you can see that this idea, most of the people go down to trade the exchange. We are not wanting to make delivery or receive delivery. We actually want to do flipping. So in other words, just like flipping property, you go to the exchange and you see what are the different products available, all right? And then you make a judgment of the market direction. If you feel that it's going up, we would buy. Yeah, we will buy, and therefore by paying a margin before expiry, we would flip and get up with a profit, and then we we are off our obligation. So that is the conceptual understanding of futures. Now, futures, the advantage is you can not only be a buyer. In the previous example, you are a buyer to buy a fridge, you are a buyer to buy a property, right? You cannot be a seller. But now you can be a seller. If you think the market is going up, the price is going up, you buy, all right, and then you sell it away at a higher price. But if you think the market is going down, yeah, you can actually go to the exchange and trade that product to sell. You sell it first. If you're correct about the direction, eventually the price actually come down, you buy back later at a cheaper price. So that would be a concept of long and short, yeah, which I'll talk about later. So therefore, you see that I give you an example, right? Just now I show you about a stocks, yeah, a stock, DBS, whereby you buy 30,000 and you hold till 36,000 and you make 20% by your initial outlay of 30,000, yeah. Now, if there is a futures for DBS, which actually there is, but just that I did not go and follow it because I don't think it is successful. So therefore, I don't really check what is the price is. Otherwise, assuming that this is the DBS stock, right? This is the chart. And there is a derivative. There's a DBS futures. These futures, the price would move very similar to this one. Yeah, very similar. Now, this is simulated. Assuming that it is very similar, not only in movement, but in price. So over here, if you want to use futures to buy DBS when DBS is at $30, all right? Assuming that the futures is worth 30,000, in this case, you do not need to put up 30,000 because futures you need only to trade with margin. You only pay a margin which typically would be in the region of 3 to 5% of the actual value. So for example, yeah, a simulated example, if you were to pay $1,000 margin to buy DBS at this level, and DBS actually go up to 36,000, all right? So you actually make $6,000, yeah, same as here. But in this case, you make 6,000 with a $1,000 margin. So can you imagine when you trade shares, you actually put up 30,000 and you make 20%. In this case, you put up only $1,000. Using $1,000 to make $6,000, you are making 600% return, 600%, all right, with the same kind of movement. Now, so this is an example of going long, yeah, going long. Now, if the market actually come off, yeah, for stocks trading, you cannot short sell. Those rules are very complex. So I know in US they allow short selling. In Singapore, I don't even know the term because I'm not exactly an active stock trader, right? So if the market is coming off, you can't short sell. But if there is a futures derivative to this underlying, you are able to capture this high and you feel that the market is actually coming off, you can short the futures, all right? Sell the futures, and if the price actually come off, you would buy back at a later price. Now, so if it is going up, you buy at 30,000, sell at 36,000, make $6,000 using $1,000 margin. If you think the market is coming off, you do the same thing. You put a $1,000 margin to initiate a short position. That means you sell here at 36,000, and if the price actually come off to 30,000, you buy back again later at a cheaper price. So essentially, the idea of long is to buy low, sell high, right? You buy low first and you sell high later. Yeah, this is something that stock traders are very familiar. However, if the market become bearish, what you want to do is you short. Short meaning that you sell high first, and the price actually come down, you buy back low later. All right, so that is how you make money. But to complete the story, I also want to show you what if you are wrong. If you're wrong, that means you buy, you long already, instead of going up, the market actually go down, right? So you think you buy low, but you need to sell lower. This is how you lose money for futures, all right? And you think it's very high already, right? You try to short the market, you think you sell high, but the market actually go higher. So you need to buy back at a higher price, and that is how you lose money. So what we want to do for futures is we are trying to aim to do this, yeah? Buy low, sell high, or sell high, buy low. But if you're wrong, then this would be the outcome. That is how you lose money, all right? So, okay, this will be the actual thing, yeah, actual thing. S&P, I'm sure you heard of S&P index, yeah. So S&P 500, this is the index of 500 500 American stocks. So with a certain formula, these 500 shares moving up and down, it will channel into a certain number that is called the S&P 500 index. So this index will show you the movement of these 500 stocks. So typically, if you don't want to choose stocks, you want to just trade the whole basket of 500 stocks at one go, then you need to use a derivative because this is just a number. So therefore, there will be a S&P futures, all right, which is a derivative. Now you can see that the derivative move very similar to the underlying cash market. Okay, so a futures will have to be defined. So once you want to trade any futures, you make sure you go to the exchange and you understand the contract specs, because every different futures will have different contract specs. S&P, for example, they will define that every jump will be a quarter point, and every quarter point has a value of $12.50, which means that one full point will have 4 jumps. Yeah, so one full point will be worth $50. So because of that, the value of the contract is $50 times the index value. Okay, now the rest of the contract specs you need to find out yourself. So tonight I will not go through the technicalities of the contract specs, but just to show you the value. So therefore, S&P during last year, it rose to a high of 4,800. Yeah, and from then until now in June, all right, over this last half month, it has dropped more than 20%. So it has dropped to, over the weekend, it has touched 3,007. So the index point from 4,008 approximately dropped up to 3,007. Now, what is the value? Remember, the value is $50 for 1 point. So $50 times the index value itself. So at the high here, S&P has got a notional value of 240,000 USD. So almost a quarter million USD. All right. And when it dropped down to this level, $50 times this, yeah, the value has dropped to 185, which means that from the high to the low, whether you are buying or you are selling, the difference here would be 40 plus 15, which is 40 plus 15, 55,000. Yeah, $55,000 difference. Okay. Now, so you see what happened is, if you trade the S&P futures, that is what happened, that before that, on the way up, if you're trying to buy, you will use a margin. Yeah, now the margin for such a big contract will be in the region of at least 10,000 US dollar. So with 10,000 US dollar, you're able to buy a contract that is about 200,000, for example. Yeah, and if you can hold it to make like $40,000 using $10,000, so that is the kind of returns you're talking about doing futures. And if you feel that, if you understand the market theory and you blend in together about fundamentals and everything else, you feel that the market is toppish here and you sell, right? Assuming that at this high point, a short position holding it for 20% decline would allow you to make 240,000 minus 185. That means you can make 55,000 on the way down using a margin of about 10,000 USD. Yeah, or similarly, using a margin of 10,000 USD, you will be able to make the amount of up move, all right, using futures. So, okay, therefore, this margin, I hope you understand by now, yeah, is leverage. So leverage concept means you use a small effort, you can have a huge load. So basically, with a $10,000 small little effort, you can get exposure of $200,000. So that is the power of leverage. All right. So therefore, to summarize this thing on futures, keyword is margin based. Margin implies leverage, and leverage is a double-edged sword. So far, I show you how you can make a lot of income. Yeah, that is provided you understand the market theory and you are correct about the direction. If you are wrong about the direction and you do not know how to cut loss, you can lose a lot of money and you can lose it very, very fast. All right. So margin is a leverage, which is a double-edged sword, and you need to know that futures involve expiry. So therefore, basically, as a speculator, we just need to know when the contract will expire, and we do not want to hold our position until expiry because it will involve delivery. All right. So therefore, with that, I have basically given you the conceptual understanding of what futures is. Now I'll move on to the next product, yeah, that is called options, which is equivalent to something that you might be familiar, that is called warrants. Okay, so again, what are options? Just to give you a conceptual illustration, I will use the example of insurance. All right, insurance, something that all of us are very familiar. Now, insurance, you are familiar with these few terminology. That means you are insuring against a particular event. All right, this event, if it were to take place, then you will get paid out, right? So you have to pay a premium, yeah, to insure. You pay a premium, and then there will be a term, how long you are going to insure, all right? And if your term is over, then it will be expired. So therefore, if the event take place within the term, you will get payout, right? If the event take place after the term, it is expired, then you will not get payout. Yeah, so something that we are all familiar. Now, example, one very common insurance that we buy would be car insurance. Yeah, all of us, we are driver by law, we need to be insured. So, for example, the event is a car accident. All right. So for a 1 year, term, assuming that I pay approximately $2,000, yeah, 1 year for the car accident. Okay. Now, if I really get an accident, depending on the severity of the accident, I get payout. In the worst case scenario, if my car is worth about $200,000, yeah, I will get a full $200,000 payout compensation. All right. So within the term. So this will be the example. But if within that 1 year I do not get any accident, then I would lose this premium. Yeah, this premium is actually just to buy. I pay with a peace of mind to get myself insured. So if let's say expire already, right, then I would not get any payout and the premium would be totally gone. Okay, so this is an example that you are familiar. Yeah. Now I use another example which on life insurance. So for example, you want to insure someone's life. Yeah, your spouse, for example, you want to insure your spouse by paying a $500,000 premium, right? Why do you pay so much? Because you want a huge payout. If the life is gone, you want the payout to be $20 million. So how long? Maybe also same thing. I buy a 1 year term. So if the spouse die, all right, I will get a $20 million payout. If the fella die after this 1 year, then I won't get any payout. So the whole premium will be gone. Yeah. Now, I'm using a rather morbid example. So I beg your pardon if you don't like this example, but I'm trying to illustrate to you that in terms of insurance, most of the time as an insurer, we do not want this thing to happen. For example, right, we buy a car insurance, we actually do not want to get into an accident. Yeah. However, I'm giving you a very morbid example. For example, if let's say you are very evil and you're trying to murder your spouse, but in the whole planning of murdering your spouse, yeah, you want to make it as though it is an accident. So you heavily insure. Now, in this example, my key point is you actually want this to happen. Not only you want it to happen, you are trying to make it happen. All right. So if you can understand this concept, yeah, then you understand options. Basically, options is it works like a kind of insurance concept. So the event is what you either want the event that the market would go up, or you want to insure for the event that the market would go down. All right. So if you think the market would go up, you want to buy an insurance that is called a call option. Yeah. If you want to insure for the market going down, you would buy an option that is called a put option. So this term called call and put is very common. If let's say you trade options or warrants, you ought to know this. All right, call is to go up, put is to go down. And the premium, now the premium depends on a lot of factor, on the strike price, on volatility, on whatever. Yeah, so typically a lot of people trade options, they would want to pay a certain amount of money that is not too huge, not too small. All right, for example, it can be as little as like $200. So they pay a $200 premium to buy a call option. All right. Now, therefore, what happened is you have to also choose the term. The longer the term, the more expensive the premium will be. The shorter the term, the cheaper the term will be. So just like insurance lah. So if let's say you buy a call option that before expiry, all right, the event actually happened, and depends on the severity, how high the market go up and how fast, yeah, your premium would increase, and that is how you get your payout. That's how you earn your money. So typically people would like to time the market, understanding market theory. They pay a $200, buy a call. If they are correct, they will double this amount. All right, or they can even make a lot if they really catch a timing at a very good market price. Yeah, so the payout could be anything from here or even less or even more. Okay, but take note, if your timing of market is no good, you buy a call and your call expire. Once your call option expire the next day, then the market move, then is none of your business. All right. So therefore, now take note, yeah, the expiry of option is just like expiry of an insurance. So you will be covered as long as it is before expiry, but once it is expired, your premium would be totally gone. It becomes worthless. All right. So this would be an example of an up, this is an example of a down. The rest of the things would be similar, just that the direction is different. Okay. Now, so that would be the idea of option. So I'm using an example of the S&P. Yeah, S&P. Usually, option is also in US is more complex. They have options to trade stocks. They also have options that is tied into futures. Yeah, so that becomes a multiple complexity because you're talking about using futures to hedge option or using options to hedge futures or to hedge outright. Okay, that one I won't cover. Now, assuming just now I show the S&P price, right? If you look at S&P fluctuation, when the market players see the market testing this, testing this, and they find that, hey, this looks like a temporary support, right? So they wish to buy here. Now, of course, you can buy with ETF, all right, just like trading stocks, or you can buy futures, yeah, or you can use option. That means option is just like an insurance. You pay a small little premium like $200 at this price. If the market actually go up, as long as before it expires it goes up, right, I will be able to get my payout. So they will buy a call option over here to bet the market going up and they will make money. Now, if at this level they see weakness and they find that the market would be going down, all right, so to short the market with a view that it goes down, people with option, they would buy a put. So they buy a put option, same thing, paying the premium. If this thing doesn't happen, what they lose is their premium. Yeah, they wouldn't lose more than that. But if the event actually happened, then this premium would grow, right? Would grow depending on the magnitude of the market move. So therefore, this would be example of how people would use option to go long or go short. Yeah, to buy a call or to buy a put. Now, the same thing applies to warrant. What is the difference? Warrant is something that Singapore exchange. I don't even know whether other country will have or not. I would think they have, huh? But anyway, stocks, right, would trade warrant in a similar manner for futures people trade option. Yeah, warrant is just like what I said just now, is an insurance. So DBS, for example, they have warrants at this level at $30. If instead of buying DBS outright, you can actually buy a call warrant. So if you are correct, your warrant price would grow. All right. So same thing. If you feel that DBS is showing weakness over here, you want to short the DBS down. Yeah. So you cannot sell the shares outright, and therefore you can buy a put warrant, just like paying an insurance premium, and you bet the event coming down. So same thing. Buy a call warrant here or buy a put warrant here allow you to make money in the direction of the DBS. Okay. Now the difference, yet another difference between warrant and option is warrant is controlled in Singapore such that you can only be a buyer. You cannot sell, which means that you can go to AIA, you can go to Prudential, you can buy, but you cannot be AIA, you cannot be Prudential. That is the option. The warrants rule, yeah, but option is more professional. Options, yeah, you can be the seller, which means that over here, if you think that the market is bottom, you can choose to be an option buyer. All right, just like you buy insurance, you pay the premium. If you are wrong, you lose the premium, but you are right, you get your payout. But I can also, if I'm bullish, yeah, I can choose to sell a put. Remember, the put is insurance to bet the market going down. Since I'm bullish, right, I feel the market will not go down. But there are other people who want to buy a put option to bet the market going down. So I can take the opposite and I sell them. Yeah. So over here, when you sell the put, you are like the insurance company. You collect the premium. So if the event doesn't happen, you would pocket the entire premium, right? But the event happens, you will have to do the payout. So therefore, options don't anyhow play unless you're pro. You please stick on to only buying, don't sell option, right? The professional option traders would definitely include selling option as part of their strategy because it is supposed to be more profitable. Okay, now, so therefore, when you think the market is low here, you can professionally choose to buy a call or sell a put. If you feel that the market is bearish over here, professionally you can choose to buy a put or to sell a call. Okay, so that would be the options concept. All right, and all this terminology, if you are keen to find out more, you have to, I'm not going to talk about that, but just to let you know, there are things like you can be a buyer or a seller of options, and therefore as a buyer you pay the premium, as a seller you would collect the premium. All right, you would be doing with call or put. Yeah, you can either buy call, buy put, sell call, or sell put, and you have to decide on the strike price. Is a fast strike price or near strike price, in the money, out of the money, at the money. And option traders will have to take note of this thing called, this is not volume, this volatility is a very, very important part of the options pricing. Okay, now volatility, and there'll be expiry term, whether you want to have a short expiry or long expiry, and option exercise type, whether it's American type or European type. So all these are the additional things that you need to find out if you are keen to really do options itself. But for tonight, I'm simply making you understand options in terms of giving you the concept that it is like insurance. Yeah, so with that, I will do a quick summary for what we have talked about so far. We have talked about stock and shares, doing outright. We have talked about using futures. We have talked about using options. Yeah, now this is the same DBS chart, but whatever this product is, yeah, whatever this product is, if you understand market theory, that the market would fluctuate up and down, and reaches a certain point you think is likely to form a swing low, it reaches a certain point you think is likely to form a swing high. These are all the different choices. The different instruments are the different choices that you can make to express your opinion of the market. All right, now express your opinion means that over here you are bullish, you want to buy, over here you are bearish, you want to sell. So I'm going to quickly do a initial summary first. If you buy like stock and shares, you pay outright $30,000, 1,000 share. Yeah, and you buy, you make over here 20%. Market bearish, you cannot short sell the shares. All right, so that is shares outright. But you can use, if there is a futures, yeah, attached to this underlying, you can use futures and you long with a margin of about $1,000 that give you an exposure of $30,000, and you make $6,000 using $1,000. That is using futures. Or you can use a option, right? You buy a call paying only a premium. So if you are correct about the move at the timing, you will get paid out. Yeah, if it doesn't happen within the timing, you will lose your entire premium. Okay, now so that is going up. Going down, you cannot short sell, but you can short with futures. Same thing with a margin. With the leverage component, you're able to make the magnitude of drop, and then you can also choose to buy an insurance, like for example buying a put, yeah, a put option, pay a premium and bet on the event going down. You will get paid out if you're correct. If you're wrong, you will lose your entire premium. All right, so that would be a quick summary at this point in time for the things that I've covered. All right, I have spent 40 minutes, yeah, quickly given you the concept of these three things: about shares, about futures, about options. Now let's talk about this thing called DLC, daily leverage certificates. It is being introduced to Singapore by SGX a few years ago, but apparently this DLC has been around in Europe and very popular for a long, long time, until a few years ago SGX decided to bring them in. Right, I personally find that it's a very ingenious kind of invention. So first of all, let me give you the conceptual understanding of DLC. Yeah, conceptual understanding. Now take a look. Take a look at this two person who is not very tall, but if you stand in a place with the light, with the light shining at a way such that you see the shadow cast on the floor. Okay, now you can see that uh, uh, you can see that their actual height is not that long, but their shadow casted on the floor is multiple times their actual height. Okay, so what I'm trying to say is the body, the actual person's body is the underlying, whereas the shadow, yeah, is the DLC. So for example, right, you have a shadow that actually make up about three times the height of the actual person. Yeah, three times. So therefore, assuming that this fella can still grow while standing here, right? If assuming he grow another 1 foot, yeah, if he grows 1 foot, what happened to this shadow? Three times, right? This shadow would be longer by 3 feet. Yeah, so that is what happened to the DLC. That means the underlying fundamentals movement would be magnified with the shadow. Okay, at the same time, if this fella, instead of growing, he shrink by 1 foot, yeah, he shrink by 1 foot, the shadow would also be shortened by 3 feet, assuming a three times relationship. Okay, so if you are okay with this concept of the body that is the underlying with a shadow, yeah, projection. Then basically you understand DLC concept already. Now, the characteristics of the DLC leverage product, yeah, is to introduce an element of leverage. So therefore, what happened is the underlying product, you're going to decide what DLC instrument you want to have. For SGX, they have been uh, uh, issuing a lot of DLC product to a lot of China tech stock that's listed in Hong Kong, because it is very popular and there's a lot of volatility. As though it's not enough, they want to introduce DLC product to even increase the volatility, right? So that means the underlying product, if it goes up by Y%, your DLC would be magnified, right? So this is like the body, this is like the shadow. So it depends on how they define it has to be three defined, usually either 3 times, 5 times, or 7 times. Yeah, right now I'm focusing on a long DLC and the focus on the 5 times. All right, so if you look at a 5 times long DLC, basically this shadow product would shadow the underlying body. So the underlying parent product move up by Y%, this fella will move up by 5 times Y. So that is what happened. Yeah, of course, if this fella drop, this fella will also drop. It will drop 5 times more. So therefore, whatever it happened, this fella would move in the same movement, but with a magnified kind of move. Okay, that is called a long. So they will look the same. Yeah. Now, short DLC, meaning that if you are bearish about the market, you're bearish, yeah, they would have a short DLC shadow that would reflect the price of this. As opposed to the long DLC, which will move in tandem, a short DLC would increase in value if the underlying product comes off. So if let's say you are bearish, right, you look at a short DLC product, if this fella actually come off by Y%, this fella would go up by a multiple of Y%. Yeah. So understand, right? So this is a mirror image. A short DLC would have a inverse movement from the underlying, whereas a long DLC would mirror exactly how the underlying would be moving. Okay, now let's take a look at before we look at charts, right? So you might ask me where you find the DLC. This is the issuer. SocGen has been the official designated issuer. So if you want to know more after today's introduction to you, you can go to the SocGen website, yeah, to find out more. They also have education, yeah, to let you know more about how you should know about DLC before you trade them. So now to continue with my conceptual illustration, I will show you using DBS. There is a DBS 5 times, right? Long as well as short. So therefore, if you're bullish, you look at the DBS 5 times long. If you're bearish, you look at the DBS 5 times short. So go back to this again. The underlying go up by Y%, the shadow would move by 5%. Yeah. So therefore, if I look at the DBS chart, which is the underlying, and this would be a DBS 5 times long DLC. So can you see it looks similar? This fella go up like that, this fella go up like that, right? This fella plunge and then go up, this fella plunge and then go up, and then this fella go down like that. Yeah. Now, so to show you a little bit magnified, still remember, following the same example, DBS is $30. All right. If you buy the shares outright, 1,000 lot, you need to pay $30,000. Yeah. For you to go up to $36,000, you make 20%. Use $30,000 to make 20% to catch this particular move. So that is a problem. Yeah, some people you want more volatility, and some people say, hey, I don't have $30,000 left. Can I have something cheaper or not? Now, the interesting thing is that there are two features of this DLC. Number one is it would magnify the move by either 3 times, 5 times, or 7 times. Yeah. The other feature is when it is being launched, it is usually being launched at a very, very cheap price. Cheap until it can even be considered penny stock. Penny stock, well, I define penny stock as less than $1. So for example, you take a look. Last year, December, when DBS dropped down to about $30 again, at this level, $30, the DLC equivalent is only 65 cents. Which means that you can have a choice. Yeah. Now, barring the fact that you know the rest of the details of DLC, all right, therefore you have a choice whether you want to pay $30 per share to buy DBS, or you can choose to pay 65 cents to buy a DBS DLC, yeah, per share. All right. So therefore, when this fella eventually over a period of a few weeks, it moves up 20%. Take note, how many times? 5 times. This fella move up 20%. 20% times 5, that would be 100%. So therefore, you can see how this fella would move up 100%, which means typically doubling the value, right? 65 cents, double would be 130, yeah, at least 140. Why? Because on the way up, right, there is a compounding effect. So therefore, after moving up, it is actually even become more than 100%, right, because of the compounding effect. So therefore, if you do not know about this, you pay $30 a share and you make $6 a share, yeah, and you need the capital outlay. But if you understand DLC and you are good at market theory, assuming that you can catch all these swing high, swing low point decently well, DLC, you need a much lesser capital outlay and you're able to double your initial capital for this particular move compared to only making 20%. That is long DLC. All right. Now, what if you are bearish about DBS? Then you can look at the short DLC. Yeah, the short DLC will move in inverse order. That means if the underlying go up, this thing would go down. If the underlying go down, this thing would go up, right? So therefore, when you are bearish, you see the underlying going down, you buy the short DLC, and this thing would increase in magnitude in proportion to the amount of this seller coming down. So same thing. I'm going to use DBS again, and you see the short DLC chart. All right, this is the best I can find, because the short DLC chart, apparently it is not listed that long ago, so therefore I don't have this historical data. But anyway, just to open up and show you, I only have the data from April until today, all right, which is from this period, which is good enough for me to illustrate, which means that when the DBS, from $30 go up to $37, and after this fluctuation over here, when things becomes when the fundamental development and the chart analysis such that if based on market theory, you have a view that DBS would be topish, all right? So you want to short the DBS over here. Now, do take note that you cannot short sell the stock outright, yeah? So if you wish to sell your stock here, or some people do not want to sell away their DBS share and they wish to protect against this coming down. So then what can you do? Of course, some people say, oh, I know warrant, right? Therefore, I buy a put warrant here. But you see that you can also use DLC. At this price, where the DBS is about $36, the short DLC is at 80 cents. 80 cents, yeah? And when this start to come off, right? This thing from $36 dropping to this level is about 20%. Okay, it dropped about 20%. Now, and when this dropped 20%, this will increase in value by 20% times 5 because it has got a 5 times leverage. So therefore, that explains how these 80 cents go up to value to $1.60. All right. Now, the blue color is to tell you that the blue color price here correspond to the blue color price here for the DLC, and the pink color price when from here dropped to $30. That is when the DLC short DLC from $80 move up to 160 when the DBS dropped to about $30. All right. So okay, that would be the way I would explain to you what DLC is. Yeah. Well, I have spent 52 minutes. Well, pretty decent. I'm only worried how would I rush. So basically, to do a conclusion, my conclusion is all these are basically instrument. All right. To make money, you need both. You need to understand the market. You need to have a judgment call of where is likely to be bottom, where is likely to be top. Yeah, with probability, not that we can pinpoint with accuracy, but when is the market trending up, when is the market trending down, and we decide to use what instrument to express our opinion. So today, I only cover this portion, right? I have no time to talk about this. I assume that you have some knowledge yourself, or in the future, you're going to learn this from wherever. So, all right, with this instrument, basically, I have already given you the example here, a very quick recap again. Where the market is doing a swing low, you can either buy outright when you buy shares, you can buy with margin, to long a position here, you can buy using option to buy a call option, or you can look at the DLC equivalent, right, to work with the shadow, following the body movement such that your shadow movement is magnified. Okay, now where the market is actually bearish over here, you cannot short sell shares outright, but you can actually short with futures using margin. You can short with uh, options, yeah, by buying a premium, or you can do a short DLC, all right, to benefit from the 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 mother, the parent dropping, and then the shadow going up. Okay, so this would be my summary. Now, another summary to compare to you these few features, yeah, whether they are regulated, whether you can long or short, whether it's leverage, margin call, what's the maximum loss, is there any time decay and expiry. All right, now you can see that I have more than three. In fact, I've included another three so that you will understand more instrument, right, conceptually. Now, shares will be individual shares. Yeah, you choose to buy SIA, DBS, Genting, or whatever. But some people say that, hey, I don't know how to choose. Some people introduce them. Why don't you do an ETF? Basically, ETF is like the index. All right. Now, you heard of STI index, you heard of SIMSKI, heard of Hang Seng, heard of Dow Jones. So if people do not want to choose individual shares, they don't understand about sector. They want the simple way to buy the whole basket. Yeah. So therefore, ETF is called exchange traded fund. They are like funds, yeah, that actually track the movement of the index, and they package it such that you trade them like the way you trade shares. But instead of trying to find out about individual share movement, you're actually doing the whole basket that mirrors the index's movement. So therefore, you can see that shares and ETF, they are about the same. All right, they are regulated. Regulated means you trade in the exchange. You can only long, you cannot short. Yeah, there's no leverage element, there's no margin call, and your maximum loss is the initial capital. You buy DBS $30. How much can you lose? If DBS goes to zero, right? You lose $30, you will not lose more. So same thing, ETF is the same. Yeah, initial capital, and there's no time decay, there's no expiry, so you can hold for as long as you want. All right. So that would be between shares and ETF. Now, futures and CFD, what are the differences? Futures is regulated futures traded in the exchange. In fact, futures is about one of the oldest derivatives that has got more than 100 years of history. It's only in recent year as in the recent 20, 30 years, right? People start to come up with this idea of CFD, contract for difference. What is it? Actually, CFD, they copy everything about futures, right? And they are not regulated. That means it is not traded in the exchange. Any broking house with a license or without license, as long as they can have people to open account with them as a customer, they can give you a code, right? The buy and sell code, and they can let you trade CFD just like the way you trade futures. Yeah. But of course, there are some subtle differences which I will not cover here. So you just need to remember, futures is regulated, CFD would be considered non-regulated. So therefore, non-regulated, it is not traded in the exchange. The rest of them are regulated except for CFD. All right. Now, so for futures and CFD, therefore, you can long and you can short, right? So is there leverage? Yes. Whether it be margin call? Yes. Yeah. So since there's leverage and margin call, what's the maximum loss? The maximum loss is more than the initial capital. When you put on a trade, you only put on a margin. All right. When you're correct, your margin outlay would be magnified. But when you are wrong, if you don't know how to cut loss, that is when things like margin call, top up margin, yeah, or if you fail to top up and the market continue to run against you, you can lose more than your initial capital. This is something that all of you need to know about when you're trading futures and trading CFDs. Okay. All right. Then is there time decay? No. Is there expiry? Futures, there is expiry because it is regulated. Expiry is meant for you to actually take and make delivery, whereas CFD is to simulate futures. Therefore, it do away with this expiry thing. Yeah. So that would be the comparison between futures and CFD. Now options, right? Just the option is the insurance, right? Is the insurance, yeah. So therefore, it is regulated, traded in the exchange. You can long and short using call or put. There's no leverage. Yeah. Is there margin call? Now depends. Depends on whether you are buyer or seller. If you're a buyer, no margin call because all you can lose is your premium. You won't lose more than that. But if you want to write options, which means that you want to be a seller of the option, it's like the insurance company. The event happened, then you got to pay out people. So you better make sure that you are professional enough before you do selling of options, right? So if you sell options, there could be margin call if the market turn against you, yeah, and because of that, the maximum losses can be a question mark. Okay, so that is what I mean by depends. And then this is the only one with a time decay, just like insurance, yeah. The closer it is to the expiry, the less the value remaining for your premium. So there is a time decay, all right. And is there expiry? Yes. And the expiry of options would mean that now the insurance coverage cease to happen, yeah, just like insurance coverage, it is no longer effective after expiry, whereas the expiry for futures is meant for now it's time to make or take delivery. Okay, so therefore go back to the questions that some people ask me, yeah, oh, futures options, are they the same? The book or expiry? What the purpose of expiry is different. One is for delivery, one is for cessation of coverage. All right, finally, DLC traded in the exchange. You can both long and short. Yeah, you can choose your long DLC or short DLC. Leverage, yes, but the leverage is built in. The is built in the product itself 3 times, 5 times, 7 times. Yeah, is leverage without margin. So you trade the DLC just like you trade shares. The maximum you lose is the amount of initial capital. All right. So therefore, you will not lose more than your initial capital, but there's no margin call. Okay, and then there's no time decay and expiry. Inverted comma, yes. The way they define the DLC product, they need to have an expiry date such that when they expire, right, whatever the issuer issues, all these would reset again. So therefore, you have to take note that there's an expiry, but the expiry purpose is different from that of futures and options. So this is a table to tabulate to make a comparison between these 6 kind of different instruments. All right. Now, so with that, I show you just now about music theory and instrument. There's actually one more thing called different music types. Yeah, you have classical music, you have rock and roll, you have blues, you have jazz, right? So same thing. There are also different asset classes for trading. Yeah, these are the different asset classes. You can be trading agricultural product, you can be trading gold, oil, interest rate, stock index, forex. All right. So therefore, go back to the question. Some people ask me, Tom, what's the difference between forex and futures? Then you're like trying to ask me what is the difference between rock and roll and piano. Forex is an asset class, yeah, and then futures is an instrument. So that question wrong until I also do now to answer. All right. So tonight I'll answer that question on the behalf of those people who asked me long time ago. So I have come to the end of the presentation. A little bit more of things to share with you. All right. As I say, I hope this is a good, concise, conceptual understanding of these few instruments. And if you have been only a stock trader, now I'm opening your mind to see there are so many different instruments for you to express your opinion of the market, all right, that you can explore, that you can more effectively deploy your funds. Yeah. So therefore, after today, if you want to start trading but you do not know enough, call Phillip Nova. The broker support will make you understand a little bit more. Yeah. Make sure you understand contract specs, expiry, margin requirements, and so on, and how to execute the trade. All right, the user interface, and if you want to use chart, Phillip Nova, how they provide the charting software. So all this, Phillip Nova would be providing support. You contact them directly if you wish to open an account and trade any of the above instruments. Yeah. Now, however, professional trading, right, requires development of trading plan. You need to learn setups. You need to learn market theory in a more professional and complete manner. So basically, that is where I would talk about this portion. All right. Now, if you want to find out where I talk about this thing, I have another event with Phillip that is scheduled on the 26th of July on the Tuesday also, whereby I would spend 1 hour to give you a brief understanding of market behavior. Specifically, I'll talk about behavioral finance. Yeah. Now, other than this organized by Phillip, what else can you do? You can go to my education website, www.tyfutures.com. You can read about some of the blogs that is being written by our traders to know more about trading lifestyle and things like that. Yeah. Now, not so much of trading methodology, but the mindset of a trader. It will be very useful read if you're keen. And of course, professionally, what do? I trade index futures with technical analysis. So this is something which also I teach. All right. So I do have a course that I run for SGX, and it is an IBF funded course. Now, so this is the course title, which is scheduled on the 3rd of September over 2 full Saturdays. 2 full Saturdays, $2,000, but you are able to get IBF funding of 70 or 90%, depending on your age. If you are 40 years and above, you get 90% funding. 40 years and below, you get 70% funding. All right. So if you wish to know more, if you already think you know, you can go to this SGX Academy website. Quickly go and scan this QR code. That will lead you to SGX Academy website, yeah, whereby you can sign up for my course over here under Advanced. Take note, there are different courses and there are different funded program. So my program is called Professional Equities Index and Single Stock Futures Trading. All right. And then if you want to know more about this one, I do have another 2 previews with the SGX Academy website whereby I talk about this one. Yeah. So one of them is on the 2nd of August, another one on the 18th of August, which you can also attend if you wish to. All right. So with that, I have come to the end of today's session. As I say, 1 hour rather packed, but I hope it is good enough for you to have a simple understanding and to be able to differentiate between the various kind of popular derivatives that's available in the market. Time is 8:04. Apologize if I have exceeded a little bit. Philip, organizer.
Hey Tom, thank you for walking us through the various products as well as where they can go to learn more, and as well as learn more from you from the workshops that you have coming right up. Maybe for the first question, we have one question from the member of the audience right now. Attendees, if you have further questions for Tom, please go to the question box and type your questions in there. Let's start things off with Tom. Based on what you've shared today, what will be the 3 key takeaways for the members of the audience?
Wow, interesting question. I teach for so many years. um, uh, Instead of I asking you what is your takeaway, you are asking me for for what is supposed to be your takeaway. I think in my summary, I actually mentioned the few takeaways lah. The number one is that you ought to know that there are more than one way to express your opinion of the market. Many investors are stuck with stock and shares only. All right. So with today's session, I hope I have opened up your mind to the other various instruments whereby you can more effectively deploy your funds and get faster returns. But that being said, you need to spend time and effort to understand those instruments. All right. So I think that would be the one important key takeaway. Of course, the other thing is that training. Yeah, a broker will be important if you cannot do it yourself. Philip is one of the very few broker that is standing, right? I'm saying this because when I joined the floor as a floor trader, that time we have 50 over brokers to choose from to trade futures. 50 over. Really, you didn't hear wrongly, 50. But today, if you want to open a futures account in Singapore, I think there are really not many left. Okay, other than Philip, I can mention another 1 or 2 lah. But the most reliable would be Philip. So get a reliable broker to help you if you wish to walk through and trade all these so-called derivatives product. All right. And then if you need training, yeah, that is when SGX come in to offer you with the various courses so that you can shortcut your learning curve. All right. They even got the government to fund the program so that you are sponsored with a very low cost fee. You are able to get important take home. And my program is a collaboration between SGX, Philip, and myself, so that if you finish my program, you are able to get a very special small commission when you trade SIMSKI or any other offers by the exchange. Yeah, so you can choose to become a member of the exchange after you have attended my course through this collaboration project. All right, so I think that would be my answer to what I think your key takeaway ought to be.
Hey Tom, for index or stock index futures, it's price movement established by the sellers and buyers in the index futures or by its component stocks of the futures. Which is it?
All of the above. All of the above. Number one, a derivative, of course, it will mirror the underlying. All right. Now let's talk about. I assume. Okay, I cannot assume now. first of all, I assume that all of you know STI, right? Now, unfortunately, we do not have a STI futures, but we do have a similar index in Singapore, similar to STI, that is called SIMSKI. All right, SIMSKI. So SIMSKI, we have a SIMSKI futures. And if you wish to participate in the Singapore movement, then you will be trading the SIMSKI futures. All right. Now, the SIMSKI index itself would be about 20 component stocks, and the SIMSKI index itself will reflect the outcome of this 20 stock movement. Yeah, and therefore the futures would mirror the movement. It would mirror, not to the dot, but it should go up or go down together. The difference is the buyer and seller would make it go up faster or go up slower, go down faster or go down slower. Because as the index goes up, futures ought to also go up. When the index go down, the futures ought to also go down, right? But at the same time, it depends on, at any point in time, whether the buyers or the sellers in the futures is more aggressive. If the buyers are more aggressive, it will push it up faster, or to slow down the down movement, and vice versa. I hope you understand. So that will be my answer to you, where you ask, should it be the same as the stock or the buyers or sellers forces, right? If I remember correctly, that would be my answer.
Hey Tom, for DLC, right? Is it meant for only day trading?
No, no, it is not meant for only day trading. Now, I would extend this question to, in case someone asks me futures. Is futures also meant for day trading? Actually, it's about the same. To me, right? In my course, I even tell people that you can use futures as an investment tool. I think this thing that I say, a lot of people, including the exchange, might disagree with me, because many people feel that futures is a speculative tool and used for day trading. But if you know how the futures work, and you know how to handle expiry and rollover, you can actually use futures as an investment tool, and with a small margin outlay, especially if the market ever crash, right? At a low level, you go in with a rather big size with margin. But of course, that provided your understanding of the market theory is quite good. All right. You're able to go in with a margin, and you can go in with a huge size at a market crash and ride the recovery. You will be able to make a lot more return. And meanwhile, every expiry you allow to roll over, which means that you will not only make with the capital gain, but you also make with the implied dividend that's being paid out by the individual component stocks. This is not easy to understand, yeah, but if you can basically remember what I've just said, yeah, I'm giving you the idea. Now, so same thing, I repeat again, to me, futures can be used for intraday speculation up to scalping. It can also be used for long-term investment if you know how to, all right? So similarly, DLC is also meant for intraday trading, but if you wish to hold a little bit longer term, it is also possible. I personally share with some of my students, if they wish to capture a market from a certain level to a certain level, assuming you are correct, yeah, then you have to hold overnight. And DLC, when you hold overnight, you get the compounding effect if you are correct. That would be my answer.
Hey Tom, any idea for your course which you shared earlier? If you can go back to the slide to show us the QR code. For the course that you shared earlier, any idea if we can use skill futures credits to pay for the course?
Skills futures, no. No, skills futures don't have. That one is another application. We already took quite a long while. We spent at least 1 year to get the IBF funding. So I think SGX wanted it to be as soon as possible. So that means my cost is $2,000. If you're 40 years old and older, you pay only 200. But if you are 40 years and below, you will pay 600. All right. The skill features, you leave it to using it for other things. That one you cannot use skill features to offset. Anyway, I always tell my audience, before this funding, I do an equivalent cost before the pandemic. People pay me the full $2,000 to learn from me. Now you are getting this funding. My course is worth more than this amount. This is what I tell all my students, and they all agree after attending.
Hey Tom, since you're talking about course, would you be able to briefly share what students will learn from their courses?
Oh dear. I actually spent 45 minutes to talk about that. You want me to briefly share? Okay, very quickly to share with you the three M's. The three M's is called My Method Money Management. The wholesome approach is not only about method. Other than method, you need to learn how to manage your risk. That's the money management part. But to me, trading is like fighting a war whereby the mindset is very important. So I always quote Sun Tzu Fa. A big part of the thing is know thy enemy, know thyself, right? So these are the three areas which I will cover. And in terms of method, I am not a fundamental person, so I will teach technical analysis. So in technical analysis from the chart, right, there are again three components that are called DLP. D stands for direction, L stands for level, and P stands for price action. So I will teach you what are the indicators that will help you establish direction, what are the indicators that will help you determine levels, so you know where to participate and you know where to get out. And also P is price action, so you know who is aggressive, whether the buyers or the sellers, and you join the aggressive party. So that will be DLP, and how you piece them together, making it a methodology. All right. And on top of that, after the 2 days for this particular program, SGX wanted me to do a follow-up handholding whereby I will give a 1 month, uh, 1 month so-called follow-up mentorship 3 times a week. So basically 12 sessions, 3 times a week, 1 hour each over Facebook Live. So that would be very briefly what my course is about.
Hey Tom, just one last question for you from Tan. Tan is asking, can I say that not to lose more than my initial capital and to profit more, one should look at DLC?
Um, Actually, to not to lose more than your initial capital, you want to make more and yet you don't want to lose more than your initial capital. Actually, all the things that I've shared with you, right, is also possible. Futures is my forte. Futures, if you do not cut loss, then you can lose a lot more. But professional futures trader, all right, we would use futures to get in, but once we are wrong to a certain magnitude, we make sure we cut loss. So if that is the case, we define the amount of loss that we are prepared to lose. So if that is the case, you also will not lose more than what you pre-plan. So it's actually not so much about instrument per se, although if you want to just limit it to instrument, right? Technically speaking, what can you lose more than initial capital? Okay, then what you say might be correct. But if you do a cut loss, then technically speaking, even futures, yeah, you ought not to lose beyond your initial capital. Do
Hey
take
Tom,
note. Sorry,
yeah,
I
go
want to
ahead.
elaborate a
Go
little
ahead.
bit more on DLC. Now, the danger about DLC is when you trade DLC of a certain underlying that is going to be very volatile, right? There is a danger of the airbag mechanism being triggered. Okay, now you already know is like 5 times, right? 5 times meaning that if that stock actually moved 20%, yeah, 20%, in your favor, of course, 20% times 5 is 100%. One day you make 100%. But what if it is against you? If it is against you, the stock moves 20% times 5, that means you lose 100%. All right, you lose everything. Now, when this thing happen, they would trigger a airbag mechanism. All right, once this airbag mechanism is triggered, your entire initial capital would be gone. So take note, because if you remember last month or so, or last 1 2 months, all these China tech stock, they actually crash at the low. A few of the counter actually move 20. One of the counter moved 36% in a single day. And after the crash, there was a dead cat bounce, and the up move is also about 35%, which means that both long and short DLC, they also get their airbag triggered. So which means that you need to understand the market under those circumstances whereby it is possible to give you a volatility that will trigger the airbag, those are the time that you have to stay out of DLC. Okay, for more details, go to the SocGen education part to learn more.
All right, thank you so much, Tom. And that's all the time that we have today. For the questions that we were not able to answer today, rest assured that I'll run it by Tom tomorrow and we'll have the answers in our follow-up email. Okay, do look out for that. Until our next webinar, thank you so much for being a wonderful audience. And thank you to you too, Tom. Thanks for all your insights and sharing today.
Thank you everybody.
All right, have a good night and stay safe, everybody. Till our next webinar. See you then.
Bye bye.